All right, welcome back to another episode of Not Financial Advice. My name is Sean, and on today's video, we're going to be taking a look at Amazon stock. First, we're going to do a quick update on how my portfolios performed today, cover some fast news on earnings this week, and then we're going to dive into the subject right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
So it's Tuesday, January 30th of 2024. Today my portfolio is down 0.8% or 55 bucks. The S&P 500 is down about 0.6%. With technology and small cap stocks down nearly 0.75%. So here at Not Financial Advice, you're able to see 100% of my investments all of the time, not only on green days, but also on red days like today. And I have a pretty diversified portfolio, currently sitting near all-time highs, $69,700. So let's go ahead and see what the top 5 gainers and decliners of the day were here. We're just at market close and all the prices are settling down. So what we can see is that for about a week and a half running, we have TrueLeave performing very well, up 6.2% today. Vertex Pharmaceuticals is up 2.4%. And we do have a big earnings week this week. It's actually kicking off right now. And we're gonna see together what all is being reported on this week. But the market went into sort of a defensive posture today, unsure of how big tech was going to report. So we have AutoZone up 1.8%, Visa up 1.23, and then Berkshire up 1%. So those were the top 5 gainers of the day. We have a pretty defensive day as the stock market is bracing for these earnings, which I think are going to be positive, but only time will tell. So bottom 5 decliners are Scott's Miracle-Gro, down 3%, down 2.8 is Winnebago, down 2.25% is Netflix, down 2.1% is Intel, and lastly, down 1.9% is Apple. So as we get into this, a couple of things. I'll ask you to like the video and subscribe to the channel. And if there's a stock or an ETF you'd like for me to review, just go ahead and drop that ticker symbol in the comments below. Okay, so when it comes to earnings this week, we're right here. We're at market close on Tuesday. So here in the next hour or so, we're going to see the results for Microsoft, AMD, Alphabet, or Google, as well as Starbucks. We also have MasterCard reporting before open tomorrow. And after close on Thursday, there are a lot of big names: Apple reporting, Amazon reporting, Meta reporting. And then again on Thursday morning, you also have Altria reporting. Let's jump into the topic of today's video now, which is Amazon, the most powerful company in the world. So we can see over all time, it's up just an incredible amount. And if we zoom in on the last 5 years, we can see that it's up 96%, about 16% a year, beating the market. But it hasn't been a smooth ride necessarily. So it looks like all-time highs were 186 rather. And so from that point of all-time highs at $186, the stock went down 55%. Since we saw this 55% decline, we've gone on to see the stock raise about 85, or rather 90%. And so the story of this stock for me is this is one of my highest conviction, first, and longest held positions. And unfortunately for me, things that I learned that I now share with my audience about position sizing, and things of that nature. When I look at the total returns for my holdings on Amazon, at this time I'm down about 5% or so. And so bought too much here and not enough here. And that's where I sit. So let's get into Amazon as it pertains to how they make money. And so Amazon is a really well diversified company. I think it would certainly be fair to call it a conglomerate. Okay. And so we did a search and we're on Investopedia. The question was, how does Amazon make money? Let's do a fast read through together. So Amazon is the world's largest online retailer. It's grown rapidly in a broad range of businesses, including its core e commerce, also cloud services and digital advertising. Amazon sells products such as the Alexa personal assistant and related ecosystem, Kindle e reader, Fire TV, and movies and television shows through its Amazon Prime Video platform. Amazon's rivals include Walmart and Alibaba. So, key takeaways on Amazon. Amazon makes money through its retail subscription, web services, and other channels, which we're going to be breaking down in pretty granular detail here in a second. So, retail remains Amazon's primary source of revenue, with online and physical stores together accounting for the biggest share. So Amazon Web Services currently generates the majority of Amazon's operating profits and is growing at a robust pace. That's all true. So let's move on to the pros and cons of a potential investment in Amazon. And so this is what I now know, what I can see, what I'm sharing with you, and things that uh, I was not fully aware of when I first made that investment. So I certainly hope to educate you when it comes to this great company. I'll ask you to like the video and subscribe to the channel. And let's go through these pros and cons real quick. So, Amazon has a wide moat. You're not going to be able to displace it. It's recently ended its cycle of investment. It's ended its capex round. So they were planting seeds to allow the money trees to grow. And so COVID pulled forward the demand for online retail. Before COVID, online retail was something like 5, 7, 9% of all of all commerce in the consumer discretionary space. It's projected, in 15, 10 years that online will be 40% of retail. And so that's one of the biggest secular trends that pushes Amazon forward. There's a primary reason I invested in it at first, and only later did I learn what I got as part of a package deal. So that takes us to our next point here. Another pro of Amazon is that it's the leader in cloud. So, to put simply, AWS, Amazon's cloud computing segment, it's basically the home for the internet. So they offer online cloud-based infrastructure and tools for governments, corporations, and companies. Just off the top of my head, I believe Netflix is hosted on AWS, and they also did a package for some government intelligence type groups in the UK. So AWS is a really powerful, high margin business, and that really should be the focus of the Amazon investment. And the leader in that space, that's where the majority of their profit is coming from currently. So we discussed this line here, secular trend of retail moving online, but there's also some other profit drivers for Amazon. And so this is where we get down to the crux of the matter. If you think about Costco, they sell a hot dog and a soda pop for $1.99 to get people in the door. So they'll spend $1,000 on groceries and a TV. That's called a loss leader. And so retail, the prime trucks you see up and down the highway, that's a loss leader. They don't really make money on the retail business. Now, I think they will in the future. But the way that they do this is they get you sucked into this ecosystem. So people pay $120 a year for a prime subscription. Um, and that includes obviously their streaming service, Amazon Prime, TVs, movie shows. But with that, that's just something that you get for free. So the company, it's not complicated, but it's very multifaceted. So a big part of their profit comes from Prime, from subscriptions. And so you have people in America and all around the world who pay $120 a month, and what they're actually paying for is just to get essentially anything they want at their door in like 36 hours. And so yeah, that's that. And once they get you into that ecosystem, this is a sticky business, which you want to see in a technology business. Speaking of that, they're growing their ads business. So Amazon is one of the most powerful advertising platforms. So third-party sellers can pay Amazon to boost their products, and so that's a high margin and growing business. An important part of Amazon's story that isn't told as often. And then the question is, what's their next venture? Is it into healthcare? So, about 5 years ago, they bought Whole Foods. They've also been buying up some different healthcare type companies, and they've recently added a $5 a month fee for Prime subscribers to get access to like 80 generic medicines, as well as video access to nurse practitioners or something like that. And so, the thought that comes into my mind is, what would stop them from opening up their own pharmacies in all of their Whole Foods locations? And then also keeping that online, shipping medicines direct to the customer's door. That's a pretty defensive business that can balance out some of the, more heady technology aspects. And so, they do have that exposure to consumer cyclical um, through their retail business, but they also do things that are more defensive, such as owning Whole Foods, a grocery store, or the reoccurring revenue of Prime or healthcare. And so I really like the different properties that Netflix owns. So let's look at some of the cons of a potential Netflix investment. So always when you have a mega cap tech company, you have the risk of antitrust lawsuits or legislation from either the US or the EU. And that's always a risk that the company could be broken up. But if that was to happen and it was broken into three companies, that wouldn't be horrible either. And current shareholders would be benefited by that. They'd be issued shares. So I'm not really worried about that. Retail again is a loss leader, but at the same time, they've just doubled their infrastructure. So, just to think about how powerful Amazon is when it comes to their retail business, I would say that their infrastructure for deliveries rivals the United States Postal Service, FedEx, UPS, Walmart, and Domino's combined. Amazon can get a lot of people, a lot of stuff really, really quickly. It used to be a week or 2 days. Now it's a day and a half or even same day in a lot of major metro markets. And so, for that, we don't know how much longer it'll be a loss leader and unprofitable, and it could remain that way forever and not be a bad thing for the stock, but just something to keep in perspective. So there is competition in cloud. Microsoft Azure is number two, a distant second, but they could have growth slow there. Also, the question is, how much bigger can this company get? What's their ability for top line revenue growth? And I think the story of Amazon is about unlocking profitability. We're going to touch on that as well. But then the question is, they've traded at a very high historical PE valuation. Could there be valuation contractions just due to different market conditions? Absolutely. Absolutely. And then in case of a potential recession, which comes, every 2 to 5 years and different degrees of severity, you can see a decline in demand for those consumer discretionary goods in their retail business. Less people buying TVs or tennis shoes or jewelry, um, you know, arts and crafts, anything that you might buy on Amazon, the demand for that could go down, but we've seen historically that recessions always end. So those are the pros and cons on an Amazon investment. Let's see what else we can learn about this company together. I'll ask you to like the video and subscribe to the channel. And let's take a look. I went ahead and prepared this graph for you. I think it would be helpful. So let's take a look at Amazon's revenue by source. This is from their most recently available 10K form, filed in spring of last year. It was for all of fiscal 2022. And so what we can see here is that online stores are 43% of Amazon's revenue, as well as physical stores at 4%. And so about 45% of their revenue does not come with profit attached. The other 55% of their revenue, top line, is going to include its biggest segment, third party seller services, subscription services, advertising services, and AWS, as well as other. So the majority of their profits or earnings per share or things of that nature, it comes from that 55% of the business. And all of these different segments are growing at different rates and have different levels of profitability attached. So it's always been hard to try to put a price tag or a value on this company, but I'm going to try. And we're going to get to that here pretty quick. So I also thought it'd be helpful for you to have an understanding of where revenue is coming from by region. So 70% of Amazon's revenue is in the United States, 30% is the rest of the world, predominantly Canada and Western Europe. So that can definitely have an effect. But it's always good to keep in mind that you can have international diversification by holding American companies, and this is just sort of proof of that. So I think that covers that. Let's move on to our next area here. One of the most important parts of my videos is Qualtrim, a subscription service that I pay for, but not one I'm affiliated with. I'm going to leave the link for Qualtrim in the description below. But let's get in here. Let's look at some of the high level metrics, and then we're going to go through our different checks and minuses evaluating its balance sheet here. So Amazon is a $1.7 trillion market cap company. So it is a mega cap tech company. We can see a forward PE of 45, which is projected. We can see a very, at this time, they've just done a lot of investment for the last 2 years in that infrastructure network that gets you into that ecosystem. So they're not positive on free cash flow at the moment. Definitely disappointed a lot of people because they had many years of positive free cash flow after being unprofitable on that bottom line for decades. Um, but yeah, we'll just judge everything on its own merits and then you can decide. So, looking at the rest of this, we're going to get into our checks and minuses now. So, looking at revenue, top line revenue growth for Amazon, it's massively up and to the right. In the last 5 years, they're up 17% a year in revenue. But with all that being said, revenue growth for Amazon is a big check mark. So, moving on, taking a look at free cash flow, we're going to take a look at free cash flow minus what they pay to executives. I have to rate it as a red X. Um, you know, if we look back over all time, back in 1999, they didn't post free cash flow. And the original CEO, Jeff Bezos, constantly, was reassuring shareholders, we're going to invest and invest and invest and invest until we become an untouchable company. And for people who believed that and bought in to the vision, they were rewarded wildly as the company became positive in free cash flow in a pretty strong way in 2007, where the company continued to post, for the most part, growing free cash flows all the way until the year, the 2019 fiscal year. And then COVID had a big impact, and the new CEO, Andy Jassy, had to make some tough decisions. They could no longer do what they promised they would do, which was get you things fast. They were struggling with that, and so they doubled their infrastructure in the United States and around the world for fulfilling online retail orders. That cost a lot of money. Increase in cost of labor, higher interest rates for borrowing, and paying interest on bonds. So it is a red X on free cash flow. But I am going to make a projection that in the next few quarters or next few years, they should be able to easily get back to this number of free cash flow, which they ramped up to. But I'm going to be projecting future cash flow around this 17 billion mark. Although I think the truth of the matter is you could see in 5 years free cash flow closer to 30, 40 billion. So time will tell. But again, that is a red X, unfortunately. So looking at Amazon and its $159 stock, let's take a look at earnings per share. For the most part, this looks pretty good. This is a way that companies are valued in the short run, as especially by Wall Street, and so this is up and to the right. Understanding the investments that they've had to make, I'm going to give this a pass. And so for EPS, they're going to go ahead and get a check mark from me, and let's move on to the next metric that matters. So looking at cash and debt on Amazon, they have about the same amount of cash as they do debt. This isn't the best trend. I think it'll improve in the future. Um, at the same time, they've got more of the cash than debt, and they just did a huge round of investment. So I will be rating this cash and debt as a check mark. Let's move on to the next topic on Amazon. So when it comes to shares outstanding, Amazon is going to get a neutral rating. They've been diluting slightly, less than 1% a year. But as the stock price has really risen a lot over the last 10 years, it is a understandable decision as far as ways to get new funding. Let's take a look at their return on capital employed over the last 10 years. So recently at 4%, not great, not horrible. It looks like the sort of median number throughout this time range would be more like between 11 and 6%. So call it about 8% average return on capital employed. Not the best, not the worst, but for one of the biggest companies in the world that has a lot of fixed costs, a lot of infrastructure, I'm going to give this a check mark. Looking at profit margin on the company, their very bottom line, they were able to get up to as much as 7% during the height of COVID. Really, really good. Keep in mind, Walmart's something like 2.3%, right? And so even prior to COVID, they had twice the amount of bottom line profit margin as a company like Walmart would. I'm going to give this a pretty strong check mark in my approximation. So that covers those two. Looking at expenses, they're gonna get a red X because their expenses are growing. Not not too many more editorialized comments I'm gonna leave on that. So we've just gone through our checks and minuses on Amazon's $159 stock. Kind of a mixed bag there. So let's get over here and take a look at all right, so Amazon's trading at $159 a share. We're going to do our rough DCF estimate for Amazon. Reminder that this is a projection of cash flow, which I described earlier. And this is for the most recent quarter, their cash on hand as well as their total debt, shares outstanding, all data lifted from Qualtrim. These projections of growth are my own, 15% over the next 5 years, slowing to 7.5% year 6 through 10, terminal growth rate of 3%, 10% discount rate. $155 stock value based on free cash flow is only $50. But I don't think that that tells the whole story. So let's take a look at a valuation for Amazon on an earnings per share multiple. And so taking a look at Amazon's $159 stock, sorry, I misspoke earlier. Based on free cash flow, we saw a value of $50. Now, doing an earnings per share multiple, which can be used to value growth companies and is a metric I think favored by Wall Street. Looking at earnings per share or PE valuation multiple, metric here, what we can see is the earnings per share over the last 4 quarters were $1.92. Amazon has a historical median PE of 79.5. I have an expected growth rate of 20% for earnings per share growth. I think that's conservative. Zero on margin of safety and growth decline with a 10% discount rate. $159 stock, earnings per share, multiple valuation, $236. Fair value estimate average is 143. And so we have $159 stock. I think it's around fair value, give or take 15%. And so, sort of a similar theme as some of the, more recent videos that I've done. Let's get over here and look at this price chart to end that. I'm reminded of the quote by Peter Lynch that investing is more of an art than a science, and those who view things in a very rigid construct sometimes can be at a disadvantage. So, while I think Amazon is around fair value, meaning I think it would probably return about 10% a year moving forward from this valuation. It might be more or less. I don't think that you lose money investing today in 5 or 10 years. I think Amazon is a really good investment for me. And so it's better to buy when prices are low so you could get those really outsized returns like we saw here. If there are any other companies or stocks rather, slash ETFs you'd like for me to review, just go ahead and drop its ticker symbol in the comments below. And I'd be more than happy to make a video for you. Thanks for stopping by. Make sure to hit like and subscribe on the way out. This is Sean with Not Financial Advice, and I will see you on the next one.